Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today's video is going to be on Lowe's company, and I wanted to really cover this video for a couple reasons. First of all, I was inspired to produce this video thanks to an excellent piece of research that was done by my friend Adam, better known as Dividend Sensei, where he did a very comprehensive article he published on Seeking Alpha, covering actually Home Depot and Lowe's. And as you can see, I'm not going to go through the whole article here. He really provided some really comprehensive information about both companies, Lowe's and Home Depot. Now, I consider research and due diligence, comprehensive research and due diligence, critical. And when I originally developed FastGraphs for myself, the idea was for it to be the first step into a more comprehensive research and due diligence process. Because I really don't want to waste my time doing a lot of comprehensive research and due diligence unless I can find a company that's reasonably valued. But valuation is really a multifaceted concept, and I have found in talking to a lot of investors over the years that a lot of people don't really get some of the nuances of valuations. So let me use Lowe's here as an example of, first of all, an above-average growing business. Now, this goes back to where they went public in 1999, so this is the full history of Lowe's. The company's earnings growth rate has averaged 14.5%. This is a very important factor to consider here. Now, they did have some problems during the Great Recession, and a lot of people believe that these companies, will suffer during a recession. But I want to contrast that. If you look at the recession of 2000, the company actually had a spectacular year. The idea being that people may not be building houses, but they're remodeling their houses. And either way, this company, or companies in this sector, both Lowe's and Home Depot, did very well. And Home Depot looks a lot like this, by the way. But here's a point. The company did have some earnings weakness. Now, they stayed very, very profitable. They raised their dividend every year. They've increased their dividend for over 56 years. That calls them not only a dividend aristocrat, but a dividend king. So it has an exemplary dividend record. And I'll show you growth rates here a little bit later. But the point is, the company's stock price tracked that drop in earnings growth that occurred, even though their dividend continued to rise. But there's something I want you to notice here. Because of the compounding effect of dividends, even had you bought this stock at its highest valuation in 2002, because of the compounding effect, where they turned earnings from 93 cents to an expectation of $5.56 by January of 2020, which will be their current fiscal year end, you would have still had an opportunity to make a very nice rate of return on Lowe's. Where you'd have averaged, including dividends, 8.8% per annum. And that's actually slightly better than the 200-year average returns for stocks in general. Now, had you bought the stock when it was fairly valued, this is a different time frame, keep in mind, your rate of return would have ballooned up to 11.5%. Now, you would have had a few years of weak results. I do want you to notice that. In other words, had you went ahead and bought it in just come before, a year or so coming before the recession and gone into the throes of the recession, you'd have actually lost about 27% of your money had you been foolish enough to sell out. But considering that the stock was raising their dividend and considering that, they still had a very bright future, keep in mind, this recession was created by the housing bubble, where you had loose credit. So this impacted companies like Lowe's and Home Depot more than what I would consider to be a normal recession. But I also want you to know, since coming out of that recession, that earnings growth went from 14.5% on average to over 16%. And if I cut one more year off of that and cut it back to really the beginning of fiscal year 2012, if you will, or 13, depending how you measure it, the earnings growth rate was actually higher. I meant to take one more year off. If you go back to fiscal year starting in January 2013, the growth rate averaged 17.7%. Now look what that means to earnings here. This is what I really want you to get across. Now this orange line is a fair valuation reference. And because the growth rate is high here, we're calculating that to be a PE ratio of 17.7. So no matter where you touch this orange line, it would be a PE ratio of 17.7. The blue line represents the normal PE ratio, and over this time frame, it's 21.5. Now that's kind of a best fit valuation. for one aspect, but from another aspect, it's the valuation that the market has had a penchant to value this. So I think you can safely say by looking at this graph, since 2013, if you will, the market's been valuing this stock at between 17 and 21 times earnings. And the rate of return, if I calculate performance using the normal PE as a fair valuation reference, we outperformed the stock market in dividend income. We also outperformed it in growth, and we significantly outperformed it in total rate of return. Now that's significant because this has been a very, very excellent time for the market, because the market was coming off of trough valuations. And we've had, a better market environment than we've had in a long time since coming out of the Great Recession. But the key is this. Here's what I want you to understand. The company's earnings went from $2.16 to over $5.57 expected for this coming fiscal year, or we'll go back to last year to $5.10. So that's more than a doubling of earnings, if you will, in just this short period of time, this 6 or 7 year period of time here. And that's about a 17.7 or 17 or 18% growth rate, if you will. Now, when you also look at performance, you'll see that the total rate of return of 17.4% was obviously correlated very highly with the growth rate that the company achieved as a business. So when you have a fast-growing business like this, as I tried to point out earlier, you can't really overpay for it in the long run as long as you're willing to hold it and as long as the company keeps generating good earnings. But the real reality of it here is I don't consider this stock undervalued. I consider it fully valued on an intrinsic value basis, because it's even above the orange line, even if I shorten it to this short time frame. But it's within what I would call a reasonable variation of this midpoint of valuation, we'll call it, the orange line. You can see that more clearly by looking at the forecasting graphs. The orange lines here would represent a valuation corridor. So it's fully valued, meaning it's on the upper end of fair valuation. If I value the stock based on its normal multiple of 21 that the market's been applying here in recent years, the stock does look undervalued. Now, that's a decision that every investor has to make. But I really want to get across here that it's the dynamic growth rate here that really drives this company and makes me or anyone else consider, because look at their dividend growth rate. It's averaged over 20% since January 31st, 2012. Now, if I go all the way back as far as I can to their, very beginnings here, going back to 1999, it has an average growth rate of 24.3 and a compound average growth rate of 23.3, just two different ways to calculate the same data. So this is a powerful growth story, and it's the growth of earnings that have really driven this company. But there are other factors that go into valuation. I want to look at dividend yields here. I'm going to overlay historical dividend yields on this graph. Now, these red dots would represent year-end dividend yields. Okay, the company currently offers a 2.2% dividend yield. Historically, if you look at that, last year at year end it was at 1.9, and of course the stock now has fallen a little bit, so now we have a dividend yield of 2.2. That has been 2% prior to this, has been the highest year-end dividend yield, at least, that we've had. And you can see that correlates when the valuations were clearly below the blue line here, or below the normal PE. So when valuations are lower, dividend yields tend to be higher, and this is one of the higher dividend yields that you could have ever received purchasing Lowe's throughout its entire, life's history here. So that's another valuation reference that I think is important. The company does offer a good yield, which indicates that this might be a good time to be investing in this company long term, but not because the valuation is so perfect, but because the earnings growth rate is expected to be so strong. If you look at the long-term earnings growth rate of this company, it's expected to average over 16%. This is a trend line growth rate by only 3 analysts, but if you look at the more specific year ends, you can see that it's widely followed. There are over 30 analysts expecting 9% growth for this fiscal year ending June of 2020, and then 18% in 2021, and then it drops down to 11 analysts that expect another 15%. So the point is, there are still high expectations for growth, and the rate of return potential based on those expectations expectations for the next 2 or 3 years is very, very high with good dividend growth along the way. But let's look at some other valuation references. Not just valuation, but also dividend coverage, because when I'm looking at dividend growth stocks like Lowe's or Home Depot for that matter, which I could have also covered in this article, I do want to make it clear that we get a really almost a better correlation, a valuation correlation, when I look at operating cash flows. Now, one little caveat: there is an expectation for operating cash flows to be lower. I checked that. This is also company guidance. Company guidance is talking about cash flows dropping this fiscal year, but then all the analysts are expecting it to recover. That would be the biggest drop we've seen in a while, and I'm not totally sure why that expectation is there, but I do recognize it being there. And there was a period going through the Great Recession where cash flows flattened. I wouldn't say they fell, but they flattened. But of course, that was also a time when the valuations were extremely low. And by the way, there's nothing like being able to buy a fast-growing stock like this at a very low valuation. Here, all of a sudden, you're getting these 19-20% rates of return. Now, I'm looking at multiples of operating cash flow here. But what I'm really looking for, I can take price off of this graph, and I'm going to shorten it a little bit here. What I'm really looking for is the cash flow covering the dividend income. And clearly, the company's generating way more cash flow than they need to pay that dividend. Now, the real acid test is free cash flow. Is the company generating enough free cash flow to cover the dividend? And again, that's what's left over after what they spent to run the business. And we've got, a little dicey during the Great Recession, but since the Great Recession, we have more than ample free cash flow. And again, it's expected to be negative a little bit this year, but then start growing again dramatically. Other ways to value the stock would be to take a look at EBITDA. EBITDA is a valuation reference that's closer to cash flow than it is earnings, but it actually is an earnings reference. So when you look at price to EBITDA, you see that it's trading at a little bit of a what I'll call overvaluation or full valuation on a price to EBITDA basis. And if we look at forecasting based on a normal multiple, it's reasonably valued based on EBITDA. If we look at it from just pure intrinsic, multiple of EBITDA, which I'm calculating here at 8.9 times EBITDA, it would be fully valued, but still capable of generating positive rates of return, even if you based it on that metric. If I went into Warren Buffett's favorite, operating earnings, I get another aspect of valuation that I consider to be very fascinating with this stock, and that's looking at, I went to adjusted operating, pardon me. If you go to owner's earnings, which Warren Buffett considers his favorite metric, you see some very interesting relationships here between Lowe's stock price and its owner's earnings. It looks nicely undervalued based on owner's earnings, and rates of return potential based on forecast for owner's earnings would be double-digit rates. So as I go through this with all these different multiples, I can also look at price to sales. On a price to sales basis, Lowe's looks relatively inexpensive. Now, that's kind of important because when I'm looking at this, I'm really trying to ascertain, does this company have growth potential? So here I'm looking at revenues. The company's revenue growth has been exemplary. This is what you really would call the top line. And a lot of these other metrics I mentioned here are kind of bottom line oriented. But this is really a superb company. It grows very fast, and it's that fast growth that really gives you the opportunity to make money. I don't consider this to be a screaming bargain in this market. I do consider it to be fully valued on an intrinsic value basis, perhaps undervalued on a normal multiple basis, how the market normally values, Lowe's. So I would say this would be a really good buy for someone that's looking for above average future total rate of return in an extremely high quality company. And again, my friend Dividend Sensei did a great job providing the in-depth research. So follow it up with this video. I would suggest you go ahead and read that article and learn more about why Lowe's is expected to continue to grow going forward. I like this company very much. I don't own any of it. I'm so valuation oriented, I've been reluctant to buy it, but it's getting intriguing to me now, and it's one that for the right investment objective, I think, taking a position in Lowe's today makes some sense. Home Depot is also very similar. I just think the valuation is a little too high on Home Depot relative to Lowe's. But if you look at these companies, over their long-term history, it's almost uncanny how similar both of them are, how their operating earnings records look very, very similar to each other. But I just consider Home Depot a little more fully highly valued than I do Lowe's, so I would choose Lowe's over the two of them, but I like them both very much. Anyways, it's been Chuck Carnevale saying thanks for watching. I hope this gave you some insights, not just into valuation, but how rates or returns can be generated based on how fast a company is capable of growing over time. And if you like this video, please don't forget to hit my subscribe button at the bottom here. It's Chuck Carnevale saying thanks for watching.